All right. All right, everybody. We are going to proceed with our next panel here, and it's one that I am extremely excited for. The people who are about to join me on stage are going to be talking about the market infrastructure that powers digital assets. So it's some of the less sexy stuff, but it's the stuff that needs to get built, and I think is going to be very interesting to a lot of the folks in this room, specifically the guys that come from the financial institutions and asset managers. That is all from me. Please welcome to the stage our next panel.
Great. Thank everyone for coming back for your coffee break. So we're here to talk about market infrastructure in digital assets. So my name is Tony Seo. I look after marketplace regulatory technology at NASDAQ. Almost a definition of the less sexy stuff alluded to there. And that's really what it's about. Like, is the current digital asset, it's a nascent area. From an infrastructure perspective, what more needs to be done, particularly to allow greater institutional players coming into the marketplace? We have a great lineup here, and almost wonder if it's almost true. Do we already have a lot of institutional players in the marketplace and solutions for them? So I'll let them introduce themselves, starting with Michael.
Good morning. Almost good afternoon. Michael Morrow, CEO of Genesis Trading. And Genesis Capital. Genesis Trading is an SEC FINRA registered broker-dealer, specializing in market making of over-the-counter large blocks of cryptocurrencies for institutional investors. And then about a year ago, we launched Genesis Capital, which is an institutional crypto lending business.
I'm Terrence Dempsey. I have the...
Mic's not on.
Good.
How's this?
I could just repeat everything you say, if that's easier. Do we...
Should we come back?
It's coming. But Mike, why don't you go next?
Is this one working? All right. Hi, I'm Mike Belshey. I'm founder and CEO of BitGo. We are a technology provider and a qualified custodian regulated under the Division of Banking in South Dakota, providing custody for Bitcoin digital assets, about 110 of them.
Terrence?
Yeah, I'm Terrence Dempsey. I'm the head of product for Fidelity Digital Assets, which is the business unit within Fidelity that's building out infrastructure for institutional investors to access the digital asset marketplace. We've started with a custody and trading offering.
Great. Back again, Vince Molinari, co-founder along with Chris Pilata of Templum. We are a blockchain fintech company focused on the modernization of securities law that intersect with the most innovative technologies. We operate that framework through a wholly owned subsidiary of which I'm the CEO of, Templum Markets, which is a regulated broker-dealer approved to issue digital assets as securities under Reg D, Reg S, and Reg A+. We are a registered alternative trading system approved for digital assets for secondary liquidity, a quotation bureau to publish real-time mark-to-market quotes on these instruments, as well as a qualified matching service pursuant to a private letter ruling with the U.S. Department of Treasury to transact in non-traded limited partnership interests.
Great, thank you. So I'll start with Terrence, since Fidelity is almost by definition one of the institutional players that we're talking about here. Fidelity has a new offering in the works. Can you talk a little bit more about that, Terrence?
Yeah, absolutely. So, I think on the plus side here, Fidelity has been looking at digital assets now for about 5 years. What started as proofs of concept, points of view, how could we actually participate in this new ecosystem? Is this new, asking ourselves questions like, is this new infrastructure for the future? And so we spent some time thinking up what it means to be a participant in the ecosystem. We started internally by doing things like accepting Bitcoin payments in the cafeteria back in 2015, which is now a very expensive turkey sandwich. We started our own mining operation to actually learn about the ecosystem. We started at the absolute core base foundation and functionality to learn about this. And what we've actually heard from customers was we'd be interested in actually participating in the ecosystem. And you know, what's not known maybe a lot about Fidelity, people think about this big retail brokerage platform, but we have a large institutional presence as well, 13,000 institutional customers that we service on a day-to-day basis. And so the thought process was, can we actually build a solution that may start to fill a need in the space? Can we be a little bit forward thinking and actually build out infrastructure for some of the customers? And so that's where we've landed, is we've built out a custody offering and trading offering for institutional investors.
Right. So, I mean, you built out your own custody offering, right? And from an institutional perspective, custody comes up a lot, right? So maybe this is one more for Mike and Terence, happy for you to join as well. But I mean, what's the concern, and really, as we resolve these custody issues, what would that unlock?
So with custody, I mean, it's been the missing link, I think, for institutional investors to be able to come into the space for quite some time. This is a new asset class. It's got a different set of problems. BitGo's been working on those technical problems since 2013. We pioneered multi-sig. We pioneered treasury wallets. We did those as the ecosystem grew. So we service about 15% of the Bitcoin transactions globally today. It's 15 billion in monthly transactions, actually. But custody has been the piece that's missing for institutions to come in, and they're looking for how to trust this asset. You read about an exchange that's hacked every month in 2018. So far in 2019, we've seen the same pattern. So unfortunately, it's a different asset class. It's got some security principles which need to be put in place. The current infrastructure that grew crypto needs to evolve into a more robust market structure. Probably means some separation of duties, probably means some specialization, so that institutional investors can come in safely.
Yeah, if I could just add to that, I think institutional investors are serviced differently than your regular consumer type of customer. And so with things about service and access to calling somebody is also extremely important, on top of everything Mike mentioned in terms of the pure technology and infrastructure. And so those are things that everyone's trying to solve at the same time.
Yeah, and so Michael, from like a broker-dealer perspective, the custody issue, I mean, do you see it being particularly different in the crypto marketplace? Right.
Yes, from a broker-dealer perspective, I think crypto certainly adds a wrinkle or two. From sort of the traditional securities market, that's for sure. No one really thinks about, hey, are my Google shares safe at BNY Mellon or State Street? Certainly not in the same way, kind of thinking about the security risk of really kind of maintaining private keys. And so as a broker-dealer, certainly trying to fit non-securities into a securities business is a challenge, I think, from an operator's perspective, from my view, as well as kind of from the regulatory perspective, for how SEC and FINRA would view broker-dealers kind of get involved in the cryptocurrency space.
Yeah, I mean, that's interesting. I mean, it kind of goes back a little bit to the discussion that, Vince, you had a little bit earlier about custody and whether it was necessary or even discuss, was it necessary or not necessary given some new technologies out there, right? I mean, there is a lack of something, some equivalent to a DTCC, right? Maybe this is more general, but do we see that as something that would be helpful, right? Or do we see that as counter to some of the concepts behind these digital assets?
Well, again, I'll go back to the evolution in separating Bitcoin cryptocurrencies to digital assets that are securities. So I think digital assets that are securities are going to mirror very much a lot of our current infrastructure that becomes more efficient. So we can talk about DTCC all day long and some of the great inefficiencies and cost structures and lack of transparency that puts forth. But I don't frankly think that DTCC is going to disappear anytime soon, right? So we're talking about big legacy infrastructure incumbents that aren't going to go the way of a Polaroid, right? I think you're going to see them innovate maybe in different subsidiaries. I think you see the wonderful things that Fidelity is doing now. I think you're going to see other big custodians come in. I think what BitGo's now doing and moving the space, because I think going back, who owns the asset, right, becomes the gating factor for the institutions, and what is good control and that comfort. So I think that becomes a bit of the holy grail, and as we look at it as Templum, and we talked a bit about this earlier, the unregistered security market first, because there's that lack of infrastructure. What we're really excited about now is the signaling of the market. We announced a partnership with MIAX a couple of weeks ago to take one of their existing exchanges, go back and rewrite the rules with the SEC and create a public company digital marketplace. So I think when you start to see that signaling, what is very clear for us is blockchain, smart securities are here to stay in our financial service markets, whether that's issuance, secondary liquidity, post-trade, and we're going to continue to evolve across unregistered and public securities.
Yeah, I mean, that's quite interesting. So I suppose, Terence, is kind of a good question for you, right? Looking at, there's been talk about in terms of your forays in the crypto, but into other types of digital assets, from an infrastructure perspective, do you see the same challenges there, right, into, for example, digital real estate or those style of assets?
Yeah, I think it's very similar to what we're seeing today. You know, the fidelity here, what we believe is that many assets will be digital in nature in the future, right? Whether that's tokenized or other types of assets that are have a digital format. And so what we've done is actually tried to build some of that core infrastructure from a technology perspective that is new infrastructure for financial services in the future if this were to take off. I think there are still a number of challenges there, right? Custody is one challenge that many folks are hoping to solve, and not just for Bitcoin and Ether, but some of the STOs that are out there and other tokenized securities. But there's a lot of other issues that go along with it. You know, the trading and what Vince is doing is great there. We start thinking about all of those types of issues. You know, I think custody is just one. But yeah, I think all of the infrastructure needs to be there, soup to nuts, before this really takes off.
Yeah, and I mean, and I suppose that's really what we're talking about, these missing pieces of infrastructure, right? The way I see it is a marketplace is more than just one piece of technology, right? I know, I suppose this is more a question I'll throw out there, maybe Mike, you might have a good answer for this, but kind of what are the other big holes that we're facing? And I suppose for Mike, it would be kind of areas of opportunity.
Yeah, the thing that's easy to forget is like our existing market structure. And we've got CFTC models, we've got equity models. They're a little bit different, but mostly the same. Those have evolved, you know, literally 80, 90 years, right? And the crypto markets have just emerged on the scene. Traditional players are a bit befuddled by what is this new technology? How is it different than other assets? How is it going to be regulated? So that causes delays. It's not really big enough that the upside surpasses the downside in the case that it goes away. They don't expect it to be. But anyway, missing pieces. Today, crypto is traded on centralized exchanges. They are the broker-dealer, they are the exchange, they are the clearinghouse, they are the custodian. That is a lot of central party risk on one entity. If if NASDAQ walked into the SEC and said, hey, we want to be a custodian, I mean, this doesn't happen, right? This doesn't get approved anywhere. And yet that's the way we trade digital assets today. So it's got to evolve. I believe each of these different participants has a role to play. Now, I think it could be different. I think technology is going to guide us there, but definitely we need to get away from single counterparty risk for everything.
Yeah, and if I could just add to that, I think, right now for institutions, capital is very inefficient. This is what I think Mike was pointing at, and I'll plug his great announcement this week as well. I think right now in the digital asset arena, you need to pre-fund exchanges or have post-trade settlement with folks that trade over the counter. And so you have very transparent marketplaces, but you need to pre-fund, so your capital isn't very efficient, right? So if you wanted to buy $10 million, you may have to put $10 million on 10 different exchanges. That's $100 million of capital. Or you can go off exchange, survey a couple of folks, and trade OTC, which works as well, but there's just not as much transparency as probably normal institutional investors would want. And I think that's the way that folks are going now, are leaning more OTC just from an institutional perspective for capital efficiency reasons.
I'll point to sort of a different area in terms of market infrastructure. I mean, for up until very recently, you really couldn't short the spot market. The ability for two-way price discovery, which is widely accepted, exists in every other market, just really wasn't a thing, certainly in the cash market for crypto. I didn't have a lending business until a year ago, so the ability to get institutional-sized borrow to be able to execute the short side of the trade was something that was certainly missing in the ecosystem. And I think it actually took a little bit of time for even the early crypto guys to kind of come around to the idea that shorting isn't a bad thing, right? And let them take the other side of the bet, and if they're wrong, and force them to buy back in on a short squeeze kind of scenario. And that took sort of an education kind of at the market level that enabling shorting in and of itself isn't sort of a bad idea. So that's kind of like step one. I think we're still kind of working towards the ability to take the other side and take a speculative downward bet in the spot market as it exists. And secondly, I think this concept of third-party insurance. I think institutional investors, as they kind of think about custody products, they say, great, we love your tech, but we love some big insurer to provide an insurance wrap around the product just in case something should go wrong, right? Unfortunately, and these guys would know this much better than I do, that market is really, really small, really, really expensive, and some of the policies that these guys are able to get don't really cover what it is that investors are ultimately trying to protect. I was told maybe yesterday, 2 days ago, that like not a single insurance policy has paid out. They've always found some loophole or didn't meet some criteria that prevented the insurance contracts from actually paying out. And so what good is it really serving to have some of this stuff? And so I think that is an underserved area, but a much needed area for the entire market structure to, I think, elevate to the next level.
Yeah, I mean, that's such an important point. I'm keen to hear more in terms of the other views around insurance.
Sure. Well, actually, I'm not sure. In terms of the hacks that have happened, I'm not sure the guys that were hacked were even insured. So it may be that there was no insurance, which would be a reasonable explanation for why there was no payout. But the insurance underwriters are grappling with what is this space, what is the risk. It's not a lot of participants trying to buy underwriting coverage. So, you know, they're struggling to get there as well. I also think, you know, sorry to condemn the entire insurance industry, but you know, they're pretty antiquated in terms of how they take their product to market. So when you've got a new area, a new risk, a new product, they're not quite sure what to do. Estimates seem to be that there's about $2 to $3 billion of underwriting capacity globally. Obviously, there's more than $2 to $3 billion of digital asset. That means it's going to have to come from somewhere else. There's one good element, though. The technology can help us here. We have transparency on chain. You can see where the assets are, not the cash. Fiat, you can't do this, but the digital assets you can. And so then you can then subdivide the assets into distinct silos. And if you have independent security controls, and this is a hard thing to prove, it takes auditing, it takes SOC 2 stuff, you know, you gotta do a lot of work, but if you really do partition the assets into discrete piles, you can actually take $100 million of insurance and cover $1 billion. It's not perfect, but it's something that this technology allows you to do. You've never been able to do it before.
And I think if we just add to that slightly and dial it down a bit, from the product level insurance, you know, real questions around what is covered from a SIPC level, right? Or likely not, right? There's no definition in securities law of what a digital asset is. So I'd say investor protection, customer exposure at the very base level when we look to a SIPC or some other level that may govern the broker-dealer or other regulated entities that should be introduced to the conversation as well.
I can imagine that would be an interesting conversation with your insurer, just kind of like a very esoteric organization explaining the nuances of these kind of new digital assets. That must be a very cool, difficult conversation to be having.
So a challenge of you know, the custodians coming together and creating kind of a pool of insurance, I mean, I think it's a great option. But the first thing you have to have is you have to have the custodians that are kind of at an equal playing field. And the early participants in the digital asset space were certainly weak compared to today's, you know, infrastructure. Now Fidelity's coming in at a new level, right? Bakkt is coming in at a new level. So these things are going to start to change, and it'll open up new opportunities on how you insure it.
Terrence, we probably don't want to spend 40 minutes talking about insurance, but I'd be interested to get your view.
Yeah, I think the only other observation I'd add, I think Mike had great points here about, you know, siloing funds and thinking about how you can risk weight, and it's education on both sides, right? So in traditional markets, not every asset is insured 100%, so we shouldn't have the expectation that every, you know, digital currency or digital asset under custody will also be insured up to 100%, and you know, looking at how we silo and risk weight assets in different states, right? So at a hot wallet, maybe, you know, you assume a higher amount of insurance based on what's in a hot wallet versus what's in a cold or a deeper cold storage. So I think that takes education on the investor side, but also spending a lot of time with your insurers to actually walk them through all the things Mike mentioned in terms of your control, your procedures, your processes around all of that, and coming up with a SOC 2 or SOC 1 type report for that. I'd also say, I think a lot of the insurance firms, like every other large organization, there's a pocket of people that are in there that are very friendly towards this new asset class and are trying to push and be kind of the tip of the spear there internally. And so it's educating the insurance firms not only on the new asset class, but also these policies and procedures that the firms are putting together.
Yeah, and I think policies and procedures is a good point, right? I mean, there is the technology, but there's also an aspect around what are the approaches and policies and procedures you have in place. Right? One of the points that I feel is a little bit lacking is really a kind of like a guidance or around best practice in the industry, agreement upon best practices around all of the things that keep a marketplace running smoothly, right? There has been discussion that's been going around a fair bit now about self-regulation or industry groups where there would be greater sharing around best practice or self-enforcement of this, which would help in a lot of the questions that have been discussed today, right? So I'll open up to the group in terms of your views around how do we promote best practice in this new space, right, without stifling it, right? And what do you think about self-regulation?
Well, I'll touch on that real quickly, if you don't mind. So I think it goes back to nomenclature again. When people talk about an SRO or self-regulatory organization, I think they're misguided, right? What an SRO really is making the rules, and you're talking about being a true exchange in doing so. Most of this, I think, I'd put more into trade association best standards versus an SRO. So I think, again, everybody getting a nomenclature down of what we're really talking about or intending to do. And I think you're seeing some of the beginnings of that with GDF, Adam, some other organizations stepping up to try to create some level of taxonomy, common nomenclature, rules for the industry. But I think it is very complicated when you're trying to parse cryptocurrency, digital assets, what someone may mean, but even by a digital asset, securities that are part of digital assets. So it's a bit of a lift, but the industry needs to come together.
I would agree with that. I think so. Genesis, we're part of ATOM, one of the groups that Vince just mentioned, the Association for Digital Asset Market. We were also part of the Cora conversation that took place in Chicago a couple of weeks ago among OTC participants to create sort of best practices. I think a part of the challenge, and frankly part of the beauty of this space, is that this thing is global, right? We're trying to bring market participants over that follow different laws in different jurisdictions that have different sort of cultures, frankly, and try to come up with sort of a unified set of rules for a code of conduct. And that can be challenging. It's a little bit like herding cats in a way, because people come from different backgrounds, different agendas and things like that. We all want to see, I think, the asset class move forward, but trying to get people from all over the world into like one place and kind of sit down and hammer that code is certainly a challenge. It's not for the lack of effort, frankly. I almost think that there's almost too many discussions kind of happening, and that there's some level of consolidation kind of working together may be necessary to really kind of push the agenda forward, because there's so many like little subsets here and there trying to accomplish the same thing. And then kind of the SRO aspect of it. In the US, like the spot market for Bitcoin, like there is no federal regulator to like go get SRO status from, right? CFTC doesn't touch it. The SEC is like, this is not a security, so why are you coming to me? And so I'm frankly not sure who we'd go to get that designation, even if we wanted to kind of do this in this country.
Yeah, I agree. I mean, SRO status is one aspect. I mean, I'm part of an SRO ourselves, so we are an SRO, so I understand the kind of very big distinction. But I do feel that these best practices can be shared, right? And I see you nodding to a lot of these things in the group. So Terrence, I saw you nodding a lot.
Yeah, I mean, what was just pointed out, I mean, it's keeping with the theme of the digital asset marketplace, right? There's very disparate organizations, as Michael was mentioning here, that, there's 4 folks in one group, 5 folks in another group, 10 in another group, and seven in another, and it's very tough to bring all of these groups together to agree on one set of common principles. And that's really probably something that we need in order to push this forward. Frankly, we've stayed on the sidelines from some of the trade associations, as Vince was calling them, or some of these groups that are coming together, just because of the disparate nature of it. And it's very tough to join 7 of these, right, and spend time going to 7 different meetings on a monthly basis. So how can we drive this forward as one is still an open question.
So I think this topic is actually related to what we're talking about. How do you have the SRO organizations come together when the market structure we have is so conflated? That is, we've got our exchanges today serving all roles, right? So if you try to bring a group of people together to figure out how to make any part better with best practices, in that group you've got derivatives guys, you got basic trading of a commodity, right? We've got security, you got money transmission. Like, all this stuff is in one pile, and we've got to tease it apart, build a market structure that's reasonable, and then suddenly each of those participants are going to be much easier to define what their role is, what the best practices are, and they'll be able to get to a decision quicker.
Yeah, I mean, I'm like, we're talking about infrastructure, so you'd think we'd be talking a lot about technology, but really, I think a lot of the roadblocks around infrastructure is really around the processes and practices in place. Right? The non-technology aspects are some of the things that really I feel the industry needs to be focusing upon, right? So from my perspective, there is a lot of discussion around manipulation. The SEC made some notes around manipulation following the ETF discussions. I feel there can be a lot more practices around market integrity and how the venues and operators operate their markets in a closer way, irrespective of the required regulation that is out there. Right, so this is definitely something I believe in very much. So I will ask one final question for everyone, right? And before we leave the questions for the group. So that question is, do we see the crypto market or digital asset space being similar or the same as financial markets in the future, right? How do we see that? Do we see them joining together, or do we see them being very different? So I'll start with Michael on that.
Sure. So there are obviously firms like Genesis who are trying to bring, bridge the gap between institutional money and sort of the crypto world, and have the same products and services that exist in traditional markets, make them happen in crypto. We're all going after the same pool of investor money, and that if they're expecting A, B, and C in the equities market, we should have something similar, A, B, C, sort of in the crypto market, and try to actually move that and bridge that kind of gap between the two worlds. And so firms like us is partly trying to get the crypto world a little bit closer to the traditional capital markets world. At the same time, I think there's certainly opportunities for the traditional capital market to look more like the crypto market, and potentially take a lot of the benefits of blockchain technology and try to get it to apply to existing businesses. And so hopefully, in a few years' time, there's you take the best from kind of both areas and come up with a better solution, so that there's improvements kind of happening across the entire spectrum and not just necessarily one area or the other.
Yeah, I wish I would have gone first because I completely agree. The way I'd frame it is, I think to the end investor, things will look the same to them. Maybe T2 moves to T0 and things get very efficient in the long run. But I think what's underneath, what the infrastructure, the guts, and to the banks and asset managers and service providers around there, things are going to look a lot different. It's going to act the same, it's going to be the same, but I think the underlying infrastructure will be wildly different than capital markets today. But to the end investor that's looking at the screen or calling their broker, there shouldn't be a material change other than some efficiencies that they gain.
Well, I think the technology will have more of an impact, but I think it's going to be on a longer term. So we've got a lot of different types of people out there that are used to a particular way, and anytime you go to change someone's mental metaphor of how something works, you're swimming upstream. So I think this is going to be like a pendulum swinging. We're going to swing a little bit more back towards the way markets are today. Once that starts to get hold and people get comfortable with it, we'll be able to start to bring that innovation back. One of the most exciting things about this industry, if you get the opportunity to go to the universities around the United States and talk with computer science departments and economics departments and legal departments. This is a super hot area. So the idea that even what we've seen so far in digital assets is very good, it's probably not. Actually, there's a lot better coming. And everybody's eyes have been open to this idea that, like, look, we can change the way these markets work. So if you build a better market with less risk, risk is money, that means the prices come down, prices will come down, and the markets will evolve. So anyway, I'm excited about what's come.
I guess going last, it's a bit of a summation of what everybody else has said already, but I think it's that continued evolution, and it's not just about blockchain or smart contracts today. It's what the next technology brings in the next 2 years, 5 years, and 10 years that continues to innovate across our financial market system. And that is largely a convergence of our technologists and our financial service tradition or traditional infrastructure to make it better. I think what the outcome of that really gets to be the very exciting part. Yes, there's efficiency, there is greater transparency, price discovery, which helps across the spectrum. But I think what gets really exciting is the new product creation, right? These new instruments that look at the smart security almost as the ultimate structured product vehicle. How do you look at incorporating debt, revenue participation, other aspects to create truly differentiating product? And then where are the correlation of those instruments relative to things that we thought weren't correlated before? So I think that starts to open up different opportunity because the infrastructure is then there and the product creation. And then we can dream and start to think how certain products that we're creating today have impact on global markets and what may be price and efficiency somewhere else that creates efficiency domestically here. So I think it is the kind of the transition that keeps going.
No, it's a great sum up. That's a good way to sum it up. And so this gives us some time to have some questions from the group. It's summed it up too well, Vince.
Any audience questions?
Cool, wonderful. Okay. Great. Thank you very much.
Thank you.